the majority of money, 90% is invested into stocks and mutual funds and bonds. $4 trillion sits in the 401k market. So when people tell you that you're going to run out of money at that cost of capital, first of all, they don't understand the returns that people are typically getting, and I think that was something that you raised our eyes open to was you have to find out what your investor wants, right? That's number one. You don't want to teach your capital. You want to find out what they need, what they want, and how you can supply that. And, both of us coming from wholesaling and the fix and flip world, I think we knew that we could raise capital at 10 or 12%, and people were really happy with that. I mean, we have a lot of happy investors that have been investing with us for years like that. And then we move into the multifamily space, and it's even more secure, right? It's not an empty house that we're fix and flipping for 6 months, and we can only deploy their capital at 6 months at a clip. So it's not really a 10 or 12% return. It's much less than that because we have to redeploy it. And this is a secured asset based on cash flow, 5-year deployment. They get some additional tax benefits. So why wouldn't they be excited about that? So our investors are, your investors are. You wouldn't be able to have however many doors under management you have if your investors weren't happy, right? So
yeah, no, and that's the trick, right? So, man, in the capital game, I think people either love us or hate us, right? Because,
well, as long as our investors love us, I'm happy.
That's all that matters, right? I mean, we're only subject to one type of scrutiny, and that's through your investors' eyes. And and you're realizing it too. Your investors, not all investors, need 20% returns. In fact, there's a lot of investors that will say that's risky.
Sure.
Like you show them a return like that, they assume that with risk, and they're like, "Oh hell no, not going to do that deal."
Yep.
And so
we're about stability, consistency, passivity, and we're all about return of capital first, return on capital second,